Good afternoon, everybody. Can everybody hear me okay? I'll try and project a little bit if I can, but thank you so much for your attention this afternoon, and I will try very hard to make it worthwhile. I'm Mary Driscoll, and I am with APQC.org. Who knows what that stands for? I'll give you a clue. It's not a software company, okay? It's not. This is where we get to do a little feedback. So, who is APQC? Well, APQC stands for the American Productivity and Quality Center, based in Houston. I work out of Boston because it's just too hot and muggy down there. I love to visit in January, though. We are a nonprofit business benchmarking and research organization. Okay? We've been around for over 35 years. Many people will recall the Malcolm Baldrige Quality Awards. Well, our founder, who is 90 years old and still active as ever, working with a lot of organizations today, he was one of the co-founders. He worked within the Commerce Department at that time. And the idea was we created the kind of the data gathering and analysis engine behind the award program, and we continue that work today. We're member-based, about 400 companies from all over the world, very, very large organizations, as you can imagine, that spend an awful lot of energy and talent and focus on studying their business processes and are clearly very, very committed to phrases like continuous improvement. We do workshops, week-long workshops with them on best practices in benchmarking, and we also have, what we do is we gather process metrics in the areas of supply chain, finance, product innovation, some in human capital, and we also do a lot of work in so-called field of knowledge management. So what I want to share with you today is a little bit of what we do and some of the kind of an intro to benchmarking as we share it, as we have refined it, and then we'll quickly go into the stuff that I know you're really interested in, and that is looking at the relative performance of different groups, best practice organizations versus middle-of-the-road organizations versus the laggards when it comes to all manner of financial management processes. So let's get started. Where did the word benchmark come from? Well, it did originally start with the cobbler who used to have people put their foot up on the bench and he'd trace it out and then be able to do the work on the shoes. In engineering, it refers to a reference point. So this is quite obvious, but I think it's always helpful to start with what it is, what terms we're using and throwing around. People use phrases intermixed. People will talk about KPIs, and people will talk about output measures and income measures and independent variables and dependent variables. I'll get a little bit more into what that looks like in finance later on. But I think it's just important to distinguish benchmarks from benchmarking. And I have the pleasure of looking at both sides of that fence. And what I get paid to do is to identify organizations and look at their finance organizations and identify those that are bona fide best practice. And we do that in a number of ways. I then share that with our members and our audience through a variety of media, whether it be webinars or typically white papers, private study groups. And for me, this is, a dream job. I've been a financial management researcher and journalist, previously with CFO Magazine for many years. So something of a geek in this area. I've been studying the office of the CFO. It has helped pay the rent and get the baby a new pair of shoes for almost 30 years now, and I continue to learn. And I continue to find it fascinating because things are always on the move. So what is benchmarking? It's simply being humble enough to admit that someone else or other organizations might do something better than you do, whether it's the speed of payables processing, whether it's the effectiveness with which you run your working capital management and the underlying drivers such as DPO and DSO and perhaps metrics that make sense for your individual company. It's understanding that you can always improve. And again, I've been looking at, for the last 15 years, we've been talking about driving finance transformation. And what that has largely meant is doing more with less, taking cost out, pushing for productivity. I want to argue, though, today that I have seen, and you've seen this, and you'll see this reflected in research done by others, that there is a sea change coming for finance. We've talked about business partnering and being an analytical competitor and supporting the business with stronger and more effective business analysis, but that is now coming to the fore. And the competencies and skill sets being required in finance and in your finance development pipelines are changing rapidly as companies adopt, embrace all kinds of, whether it's cloud computing or cloud finance in the cloud, but as well as, you know, the wholesale embrace of business analytics is changing finance rapidly. And I'll share a case study about that with you later on. So what is best practice methods and techniques that are consistently shown to be able to help you deliver a higher level of quality of business service? Because in essence, let's never forget, that's what finance is, a provider of a business services or a set of business services to a set of customers who have an expectation for quality level, value, and price, as well as the ability to be served as a customer. So all kinds of things go into best practice, but I find over and over again, I'll talk more about this when I give another case study in a few minutes, that the best practice finance organizations have a cultural mindset that says, we are here to serve the business. So they've just, you know, obliterated that kind of silo mentality. What we do is accounting, and we close the books, and we do it at a certain level of efficiency. It's a very different mindset. So a typical benchmarking life cycle, I mean, this is just kind of a humorous look at what companies, the resistance companies have. It's not obvious at first, if you haven't engaged in a benchmarking process, how really useful it can be. Useful, I think, not only to point out where your opportunities are for improvement, and then help you to justify the potential ROI of changing a process or automating a process or reorganizing the finance team, but also to communicate globally, well, within the organization, the power of that. So I'd just like to have a show of hands. Who has been involved with any kind of financial process benchmarking? Okay. Very good. I'd say about at least a third or half of the room. Just looking for a tissue. Air conditioning's getting to me, but we'll just carry on. Well, that's good. I'm wondering of those who did raise their hands, whether they've been involved in, you're a lifesaver, thank you, in a global effort that went around a complex set of organizations or a single process. Anybody willing to volunteer a comment about their experience with financial processing, process benchmarking? No? No, after lunch. Okay, got it. Let's just forge ahead. I want to explain what this is and why it facilitates the benchmarking process. This is what we lovingly refer to as RPCF. It was developed, started in around the mid-90s, where we got together with some of our member organizations as well as academics and consultants in the field and said, let's create a portable or a universal taxonomy of what finance processes look like. Because if you're going to benchmark, you've got to be able to compare apples and apples. And even if you're just benchmarking within units within your own organization, it really very much helps to use a taxonomy of business processes, okay? Companies use it not only for benchmarking, but understanding, standardizing and measuring their process over time. Let's take a look at what this looks like. First of all, it's free. Anyone can get it from our website. And most companies use this framework and adapt it to their own organizations. Okay, so it's very customizable, but it gives you a starting point. So again, you can download a free copy. What we look at is 5 levels of, and I don't want to get too bogged down in this. There's a lot of information on our website on this, but we'll take a process and look at the top category, the process group, the sub-process, and the activity. Here's a look at all the different processes we've mapped. The 8.0 is the managed finance ones. Let's show you what this looks like. We look at 10 different areas of finance, ranging from performance management, which is basically budgeting, forecasting, and reporting across all the basic core transaction processes, AP, AR, and things like payroll, fixed asset accounting, and so forth. When it comes to, I think probably the most popular area that people use our data has to do with the performance management aspect. People to this day continue to struggle with the question of why is it taking me 45, 60, 75 plus days to create an annual budget. And when you look at, I'm sure you've all heard this story many times over the years. My counterparts in consulting firms and academic areas always talk about the silliness of spending 2-3 months creating an annual budget that's obsolete before you're even done creating it. And I think more than anything today, companies are really struggling to come up with much more flexible or innovative approaches to budgeting, forecasting, driver-based forecasting, rolling forecasts, predictive modeling. We'll show a case of how a company is using analytics to better understand its own customers' behaviors and to model how, if you influence A, how is this going to affect your revenue stream? If you influence B for a certain set of customers, how could that possibly influence your expense levels, and so forth and so on. But it all starts with this. I just picked this out here. This is a quick look at the accounts payable. So up close, you can see all the steps involved in the end-to-end process. Why is this important? Well, it's important when you can, as I said before, customize it. Okay? What people do is they'll take those steps and use it to then model their own how they do work. And something happens here, and then something has to wait till it goes down here, and somebody else has to do something else. So you can begin to not only measure your performance, but look at the root drivers of either efficiency or lack of efficiency, particularly in an area such as the close to disclose process, okay, which is so pressurized and just so rough, and has been for 30, 40, 50 years. Companies continue to struggle with how can we go faster and at the same time ensure the integrity of our financial reports. Well, if you understand the bottlenecks in your process, if you look at your process and understand, well, darn, it's taken us 20 days to close and then release earnings, or 25 days, that, I'll tell you, is laggard process. Why do you need that much when the top performers can do it in 10? And automation is not always the answer. It has to start with understanding your process, how workflow moves, and how you might do things such as taking out redundancies, how you can streamline. Let's look at some measures. What we do measure when we collect, we have these very long and hairy benchmarking surveys that people take. These are not things you can fill out in 10 minutes at your desk. These are very, very in-depth studies that look at, people have to run around all over the place and get the data, but once they do it, they're able to get some very, very a close-up look at cost effectiveness and various aspects of that. So your process cost, your staff productivity, You know, how many invoices can one full-time executive process annually? How many remittance? Again, it's very, very appropriate when looking at your core transaction processes, okay? And when you do understand your own performance and you look and say, oh my goodness, my total cost of accounts payable or the total cost of processing an invoice is here, and the top performers are doing it for a third of what I'm spending. And if you're a company that has a significant amount of transactions, you can quickly get a picture of how much hard savings you can capture by taking steps. And you need this to justify the business case, okay? Because, you know, most organizations are very reluctant to say, let's give money to finance so the accountants can, you know, go home earlier on Fridays, right? You know, it's always, no, if we have any spare cash, we're going to give it to marketing, we're going to give it to sales, we're going to give it to product development. Finance comes last, right? And it's always, they can do more with less. Squeeze, squeeze, squeeze. So with this type of analysis, you can begin to demonstrate the hard ROI that you can pull out of benchmarking and changing your process. Process efficiency, error rates, quality rates. You know, what's our rate of first-time PO invoice match error-free? I'll show you a slide on that in just a second. Cycle time. I mentioned budgeting and forecasting time as well as financial reporting. Here's just a quick example. What I took here, excuse me. Okay, here are some, I'm sorry if this is kind of hard to read, but here's just some examples of AP efficiency indicators. So the first one is number of invoice line items received electronically, okay? And these are median figures, okay? Meaning, so we took the top quartile, so we took a group of companies and divided them into 4 buckets. The top quartile, meaning those that outperform 75% of those in the study. And then the median is the performance of the theoretical organization that sits right in the middle of the range of data. But at a glance, you know, I won't go over each single item here, but what you can see is out of 23 people providing data for this certain data point, the ones that perform the best, they have 50% more of their invoice line items produced electronically. And you'll find that theme over and over again, especially in large, complex organizations that are processing, you know, 50,000, 100,000, 500,000 transactions in AP alone or AR. AP costs. I'll take the second line there. Total cost is a percent of revenue. The top performers, 0.01. The bottom performers, 0.015. Okay? Total cost per 1,000 of revenue, 10 cents versus 14 cents. So you can be, and that's just the median. If you want to look at how the top performs versus the bottom, it's an even wider gap. The other thing that we talk about in I'm just checking the time here. Okay. There's a lot of education around how to present this kind of data. This is our funny little way of saying, how do you visualize, you know, how ingenious is the Pringles can? Okay. Well, it's pretty awesome when it's full, you know, you just pick them right out. But the point being, as the can empties, the design of the can becomes insane. All right, have you ever had your hands stuck trying to get that last Pringle out? Okay, so these are the ways you want to communicate with people what these things mean. Again, this is just, you can look at all participants in a survey. You can look at industry specific, which is recommended for things such as drivers of working capital management, okay? Or efficiency of remittance processing depends so very much on business models, so it makes sense to look at specific sets. Here, again, I just want to run through this real quickly. We can look at regions, North and South America. We can look at entity size. You typically want to look at your same size company. So over here, we're just showing the personnel cost of the AP process per FTE. Okay? So the top performers, $41,000. Bottom performers, $66,000. That includes benefits, but not systems or overhead. And then you look at the differences in top, 42,000 versus 76,000. So you got to ask yourself, why is that? And labor costs tends to be the biggest driver of cost in finance, right? So 60% of your cost of AP, just for example, is labor. So if you can begin to identify those opportunities, and then you can say what kind of changes in organizational design or automation or process we can make we can liberate some of those people and automate some of that work. I'm going to skip this one because I don't want to get too bogged down, and I won't get too bogged down in this, mainly because I know you can't read this chart. But I think these slides are available. This is an ongoing exercise of mine, especially when I get with a group of finance people. I'm trying to create a model. What goes into financial management excellence, okay? Well, a number of things. As you can see over here, the top 4 buckets I've labeled aspirational. The 3 at the bottom are foundational. You absolutely need the ability to, you need an IT roadmap so that you understand globally where your financial IT roadmap is going in alignment with the company's IT roadmap. You should have a continuous improvement mindset. You should have an organizational structure that best serves the strategy of the business. A strong and clear charter, and I'm going to show you what I think is one of the best charters for a finance group I've run across. A deep commitment to finance talent development. Again, in all the case study research that I do, and I've done a number just in the last 9 months, it's uncanny how you see, and how it's demonstrated, a very serious commitment to developing finance skill sets and competencies. And it's not just saying, oh, we need good management accountants, and we need some good FP&A people, and we need some really great payroll processors. The smart and leading edge companies keep an eye open to the need for emerging competencies. One company, Intel, has what they call a talent development review committee just for finance, okay? And you looked, are you from Intel? You went, oh, no. But in a case study I did, they shared that they have Intel University that trains people in all the core stuff, such as Monte Carlo simulation, ROI analysis, and management accounting. But they also have a separate program that they call Business Partner, how to become a solid business partner. So I have a case on this. I don't want to get too bogged down into it, but I just can't stress enough the commitment to talent development. So a recent survey that I did, we asked, what are your goals in, what are you doing? What are you looking to do if you want to transform finance? Over the years, most would have said efficiency, just take out more cost. But as I said earlier, the light blue section of the pie here, people are going for both efficiency and effectiveness. Okay, what are people focusing on? Oh, the evergreen, plan, budgeting, and forecasting, getting the planning and performance management and FP&A activities stronger than ever. But the close process, I was a little bit surprised to find that, but when I dug deeper, we found out why. Again, I won't get bogged down in that. I've got a lot of stuff on my website. A lot of it is some of it's free for non-members if you want to take a look. So what you want to do is think through the correlations of what drives performance. So here's a good one. We took a group of companies that had filled out our AP survey, and we looked at a group that were just $1 billion or more in revenue. And again, we put them into 4 buckets, and we said, what is the percentage of invoice line items that are matched the first time, okay? The top performers range anywhere from 85% to 99%. There's no such thing as 100% full-time match all the time. There's always something that pops out, right? Down at the bottom of the barrel, in the median of that group, on average, 36%. Can you imagine what their labor costs are? Right? If those things can't be handled by robots, if they have to be manually dealt with, so if there's not a match, that means a lot of calling around to the customers, procurement. At the end of the day, though, don't you really want to find out what are at the root causes of this? If there's dodgy data on shipping materials or documents, or there's been a price change that wasn't noted in the system, or anything that could mean an invoice and a PO don't match. So I also then wanted to look at what are the cost experiences of those two buckets. So I said, again, here's bucket 4, our leaders, the ones that match, pretty much most of the time, and those that don't. Look at that cost gap. Cost of AP per number of invoices processed. Okay, so you normalize for the volume, almost half. 40%, 50% of cost difference. Okay, and again, if large companies are processing hundreds of thousands, if not more, annually, that's where the real difference is. Now I'm going to fly through, in the interest of time, these next few slides. And again, if you can't get them from Proformative, I'm very happy to share this presentation so you can take some of this data. This data is I'm sharing with you something valuable, I'll have you know. People give us a lot of money for this data, but because I'm here, because I love you guys and ladies, giving it to you free. This is a look at top, medium, bottom performance, and then organized in terms of companies who perform this function in a shared services environment, dark blue bar, versus performed at the headquarters level, light blue bar, and performed decentralized, distributed at the business unit level. And we're looking here at the cycle time in days between the close and the release. So, show you some more of this in a second. We'll look more close up. But what this demonstrates more than anything is the impact of organizational design, that being in a shared services center really does drive performance, not only in terms of cost, but cycle time. Another quick one, percentage of business entities, intercompany transactions processed by automated systems. Again, medium versus top, shared services, headquarters versus business unit. Quite a difference there. But I think what that demonstrates more than anything is that when you put things in a shared services environment, you can more easily justify the investment in process optimization and the investment in automation, so that you can achieve that high level of straight-through automated processing levels. Total cost of financial reporting. Here's another killer. This again is all industries, revenue greater than 1 billion. The top performers do it for 11 cents. Bottom performers do it for 57 cents. Okay? Here's one of my favorites. I find over and over, and I'm continuing to do a new range of these kinds of dependent versus independent variable kind of correlations. I'm continuing to find that cycle speed, the faster you go, the less it costs. It's just uncanny how that's working out. But what we did here is I took companies who we looked at I called the fastest those that close in 10 days or less. All right? Those are the Speedy Gonzaleses. The slowest are those that take 25 days or more to close and release. Okay, so those are the tortoise and the hare. Then we looked at cost. So, if I'm looking just at the speedy folks here, of the speedy folks, 10 days or less, the best cost performance is 10 cents. At the median, 33. At the bottom of that speedy group, 67. Now compare that. 10 cents, the fastest top performers, versus $1.06 for the slowest, worst performance, okay? That's pretty shocking, I think. And I think a lot of companies probably could benefit from taking time to go through this kind of analysis and say, not only is it costly, but we're slow. And when you're slow, you're late getting out to the street. Even worse, you're late giving that key information, that formal picture of how did I do last quarter, back to the folks in the business. So, you know, if they're not getting their formal record of performance until a month after the close, they've only got 2 months to make an adjustment if they have to quickly make a, you know, pick up for a shortfall or change plans. It's just, in this day and age, is unjustifiable, is what many companies are telling me more and more these days. Okay. As I mentioned earlier, what you really want to do is understand the story. What is it about the people, the processes, the technology that you find again and again at these best practice companies? And how actually do they go about closing performance gaps? So here we're going to talk about performance, process performance techniques, tools, approaches. Here's a recent case study I did involving an organization called the American Academy of Physicians Assistants. Now, if anyone's been to the doctor lately, you've probably figured out, or if your family's been to the doctor, no one gets to see the doctor anymore, right? You get to see an RN who is authorized to prescribe. That's a physician assistant. And as our entire healthcare system changes, that profession is becoming, take my word for it, it's taken off. So this membership organization, an educational organization, is growing like hotcakes. Their membership's going through the roof. They're telling a good story. A new CFO arrives on the scene about 10 months ago. And he happens to have a very strong background in IT. He's just one of those people that loves to get in there with the data and start modeling. Long story short, he worked with, marketing and product development people, again, to begin to understand what were the key push points in his revenue model. What things did he want to influence, and how did he want to influence them in ways that would accelerate revenue inflow as well as increase incremental revenue. So, a quick example, they understood by looking at some data having to do with downloads from their websites and who had clicked on what promotional campaign for, whether it's a course or a textbook or some online learning, looked at who had clicked on what and what had influenced a purchase decision. Also, who had what kind of behavior online and what was their behavior in terms of membership renewal. So they used Google Analytics and they pulled some data, and presto changeo, they did some BI magic. I don't mean to belittle it or make fun of it. It's really, really impressive what they did. They very easily, you know, he talks about, rich data sets and longitudinal analysis and some fancy sounding stuff. But they were able to figure out, gee, there's 40% of our members that don't renew until the 11th hour. And that's a dangerous situation, because if people put off the purchase decision, the higher is the chance that they're going to fail to purchase. So they were able to segregate that set of customers and come up with promotional campaigns and product bundling and so forth that aim a nurture stream directly at the needs of those customers. So again, that's what I mean when CFOs are becoming more enamored of big data and business analytics. You know what, I'm going to skip over this one in the interest of time and go right to, that was just another example of how a company mapped what it needed to do and in the process of pursuing a large-scale finance transformation effort. But I want to take you to Intel's charter. Now, this was put together by Andy Bryant, who I think is now, maybe he was until recently chairman, but he's a longtime CFO and a very, very impressive individual, and his team is extremely impressive. But this is what it says we do at Intel. First and foremost, we keep the company legal. Okay, so your stewardship duties, your compliance, your need to continually drive integrity standards. The second point here is worth just focusing on for a second. The finance organization at Intel has as its second goal to maximize and grow profits. Now, does that strike someone as you don't often hear, oh, the finance is a cost center. Wait a minute. What are these guys are setting themselves the task of maximizing and growing profits? What does that mean? Well, at Intel, it means expertise and excellence in influencing resource allocation decisions, okay? And they actually have tracked for many years, hardcore numbers, how much incremental gain in operating profit, or how much incremental gain in revenue, or how much cost savings was achieved because finance was able to influence a decision in a certain way. I'll give you an example. There's a gentleman named Rick Craig at Intel, and he works in what they call business operations, but he's a finance planning and analysis person. And what he did was he said, wait, I'm in these budget meetings with, these are engineers, they're PhDs, these are process technology experts, and they're talking about theory of constraint and all this, and then they're asking me for budget increase for more equipment or more capital investment. I need to better understand what they're talking about so that I can help make a good decision. So he took it upon himself to go down into the manufacturing level, learn to have these people teach him enough to be dangerous so that he could then engage in very intelligent conversations about resource allocation and when more capital made sense and not. Finance is also committed to being a world-class provider of business services, and again, they exhibit all the right kinds of designs and global process ownership. They also protect shareholder value with a very eyes-open enterprise risk management process and fiduciary control processes. And again, they develop world-class finance professionals. But I found that very inspiring because, I've talked with the folks at Intel, and this is not something that just gets put up on a board or winds up in a drawer. They really, truly, they take it in. They personify it, okay? They believe in it, they live it, they breathe it. Office of the Controller of the Currency. We found the same kind of thing in a case study I did on them. We were looking at, I found this kind of interesting. I found out earlier this year that the Office of Management and Budget has ruled that every federal agency and every quasi-agency, that anything in the area of federal government finance has to be optimized through a shared services organization. So the Office of the Controller of the Currency actually happens to be one of their leading cases. They've been benchmarking with us for a very, very long time. But all I can say without getting too dragged into it is it's uncanny the types of methodologies, whether it's Six Sigma, whether it's Lean, whether it's Kaizen, the training, the process mapping, and the continuous benchmarking that they engage in because they fully believe in continuing to push. They don't believe there's ever an end, that there's always ways to continue and improve and find and innovate ways to improve to optimize cost, cycle time, and staff productivity. So I just wanted to summarize a bit here and then maybe open it up for discussion because I'd love to hear any contributions or ideas that could be added to my worldview on what makes for excellence in finance. But again and again, over time, the things that I see at the companies that I speak with and research is there's very much an alignment of financial management to overarching corporate objectives. Now that's easy to say, but the leading companies really do put this into practice. Northrop Grumman, for instance, the big aerospace company, is a case we did earlier this year. And I saw they gave us some examples of the performance dashboards they use for the individual level within finance, within the departmental level, and then with the finance function as a whole. And they have mapped out, well, what are the KPIs? You know, if we've got too much cash stalled in what they call suspense balances, it has to do with their contract employees. We're not getting things processed in time. We're not paying enough of we're missing out on our goal for paying within terms for certain invoices to keep our discount capture at an ideal level. So they understand, they've figured out all the drivers that then roll up into performance. And they have dashboards that they look at monthly and some quarterly and some annually. But then the higher level metrics fill into or emerge into, I might say, the senior leadership's own performance evaluation. And at that level, they tie to, well, if finance is doing these 10 things, and we're doing them well, or we want to improve them this year, how does that map to the overall organization's business strategy or current thinking or planning? So you tend to see a lot of that alignment. A move to more IT-savvy financial employees, okay? There's just, you know, I think you probably see this in a lot of professional disciplines these days, and that is, you know, you've really got to have people who can work with all kinds of platforms and applications, whether it's forecasting, modeling, scenario planning. Formal training regimens I've talked about today, the importance of influencing the business to use the shareholder capital that's allocated to them in the most economic manner, helping the business to track and monitor its economic performance, meaning it's, you know, how it well deploys its capital, net of debt service and so forth. A variety of different ways to do that. Standardize and clearly communicate the financial close process. We've done a lot on that. And process management principles and techniques. And on that one, I was just sketching together, you know, what do we mean by process improvement techniques? Well, here's one, and it's kind of obvious, but you don't often see it function well, and that is cross-functional collaboration. So I happen to be speaking with the chief procurement officer at a very, very large global consumer products company just recently, and some research I'm doing on supply chain disruption risk having to do with extreme weather. Long story short, if there's a hurricane and the ship can't get where it needs to go, or if there's something that's messing up, or a port is closed down in Asia, you know, all the usual nightmares you can think of, procurement works with finance, sales, logistics, even marketing, okay, to figure out, to model what might be the revenue hit or the cash flow hit if such and such thing happened in a specific location for a certain period of time. That's very advanced thinking. That's very proactive and predictive kind of cross-functional collaboration. You can certainly do some good in the areas of working capital management. But I'll leave you with this. What I keep finding is the smart companies don't take no for an answer. They keep digging and digging and digging to get at the root causes of process failure or inefficiency, as well as they dig at what are the drivers of excellence and how we can leverage those. So with that, ladies and gentlemen, I am out of time. there's our knowledge base. You can go there. There's a bunch of good free stuff. Help yourself. Q&A. Okay. We have a few minutes for questions and answers, comments, good, bad, or ugly. Anything? Yes, ma'am.
I was wondering if you had any distinction on your site between sizes of businesses and how, different benchmarks. So if it's an organization that's, $100 million or less versus a $1 billion organization, is there any difference?
You're asking, what you're suggesting, if I heard you correctly, is that it's very important to compare with peer groups. Yeah. Absolutely, because a $100 million company just doesn't have typically have the global operating footprint that a multi-billion-dollar company would. Transaction levels are different, so you're absolutely right, and that's an important point, along with industry, I think, as well. Yes, sir.
There was a point that you briefly mentioned when you were talking about Intel that I was surprised was not on your critical success factor chart. And I've had personal experience with it. I can vouch for how important it is. It's absolutely critical for success for not only financial management, but the financial organization to have a really good understanding of what the business actually does and how they do it.
Yeah.
When you were talking before about that guy going down on manufacturing and trying to understand it.
Yeah.
I found with my people that was critical to making the difference in their development and the success of what they did on the job.
Yes, very good point. And I kind of flew through some of these slides, but in the case we did on Intel, we dwelled on, they do have a very effective rotation program on purpose. And they want to get those, tomorrow's finance leaders, they want to give them that operating experience. They want them to spend time around sales and marketing. They want them to know the different customers. They want them to know what goes on in a chip fabrication plant. So yeah, but that key point. Thanks for bringing that up. And a lot of accounting groups don't have the bandwidth these days. They say we just don't have. We can't send, Miss Jones over to sales and marketing for a year so that when she comes back, she'll be much more effective, okay? We don't have the spare eyes and hands, but companies should. Yes, ma'am.
I'm curious about your last point about cross-functional collaboration. How does that work out, especially when you deal with large enterprises?
Well, you need authority, okay? I mean, you need senior level authority that says, this is important, and you're right, because how can finance march over to procurement or logistics and say, hey, come to my meeting, I want you part of this. They'll like, bye, I'm too busy, right? In the cases I've found, it has been something that has been, there's a problem that has been identified. It's been underscored by the CFO level, okay, and it's been made a part of everybody's goal. In fact, one case I'm thinking of, General Mills, they went to extraordinary lengths to map changes they needed to make in working capital. If they could reduce the working capital requirement, the impact that would have on return on capital. And they worked very hard to make that link. It's sometimes fuzzy, but when the business heads started to see that their ROC metrics could definitely get a measurable boost by improving working capital management. This was right after the crash, too, so it was all about inventory and everything. People took it real seriously. But it's not easy. You're right.
Do you have any data on how much time is spent by the top performers, doing their finance day-to-day duties versus doing their benchmarking, process improvement type activities?
I don't have hard data on that, but I can tell you the companies that do pop up at the top, they'll have dedicated finance transformation. They have capabilities and people and assignments. They'll take, depending on the company, you'll find a handful perhaps of people whose job it is to do nothing else. except work on process standardization, evangelizing. They tend to call them global process owners sometimes. But there'll be someone who does nothing but worry about talent development, and there's someone who makes it a point to preach the values of common data definitions and common process and make that something that the pressure stays on all the time. I don't have hard data on that, but at the best companies, you know, you see it. You see the commitment to that. Yes, sir, you had a, yes?
Yeah. A lot of the focus was on pretty large companies. And I've seen, you know, quality in Six Sigma large companies like Citigroup and American Express. But in small companies, you know, 10 million, 50 million or less, they just don't have the people to take out and do this full time. And ironically, a lot of them have really horrific numbers if you look at their efficiency numbers. Have you seen any models that are doing, you know, this kind of analysis and, you know, operation improvement in small companies?
No, not the hard data. You can see it in case study research where, again, the case I did with the gentleman from the Physicians Assistant Association. They're a small organization. You know, they have probably less than 150 people. Okay, but you tend to find innovation or pockets of innovation. You tend to find it in innovation-driven companies or industries such as electronics or software or technology, where it's kind of in the air. But, you know, at your Midwest manufacturer, pipe fitting company, it's just not going to happen. And especially companies that tend to be family-owned, they think it's a waste of families' money. So, I think we are out of time.
We are.
Thank you very much for your attention and your comments.